Hey there, I hope you're having a great day. I'm Jim Munchback, and I'm here with a 15-minute video to introduce a new investment strategy. The BayRock Bull Bear Portfolio is designed to do what all good and effective investment strategies are designed to do: maximize returns and minimize risk. Hey there, I hope you're having a great day. Jim Munchback here from BayRock Financial. I wanted to do this quick 15-minute video to share a new investment strategy. I'm calling it the Bull Bear Risk Management Strategy. So I know I could have done this video in 2 minutes, but then I would have had to use a special tool to make my lips move much faster. This is for BayRock clients. I wanted to let you know that I'm making some changes to my investment portfolio, and so I'm going to walk through that. As you know, if you're a BayRock client, you know that it all starts with your risk number. If you're a do-it-yourself investor, I want to invite you to follow along. You can subscribe to the podcast and listen as I talk about this strategy over the next several weeks. But what I really want to encourage you to do, whether you're a client or a do-it-yourself investor or just a financial advisor who works with other clients on investment management, what I want to encourage you to do is to go to the website. I'm going to scroll to the top, BayRock Financial, and you'll see there are now 4 big blue buttons at the top. So when you click on Get Your Risk Number, it will take you to our 5-minute survey, and that's where you can answer a few questions, and you will discover, in the course of doing the survey, you will get your risk number. Talk just quickly about why I started BayRock. So back in the day, when I worked on Wall Street at Morgan Stanley in the wealth management department, and even before that, when I was a certified financial planner at State Farm, the first and only CFP who could charge a fee for investment advice at State Farm in the Houston area, before I went to work on Wall Street, the entire time I was searching for a professional investment advisor who would just look me in the eye and say, here's what I do with my money. And I always believed that should be a very easy thing to find, but it really was not an easy thing to find. So when I started BayRock, it was with a very specific intention to be able to look at my clients in the eyeball and say, here's what I'm doing with my money. And I would encourage you to do it as well. And so as a fiduciary, an independent fiduciary investment advisor, it just seems like that makes sense to me. And so that's really the basis for BayRock. We do financial planning and investment management, and I'm the guy. So I'm going to be creating some training around this bull bear strategy because I want my clients to know the risk involved. I want them to make an informed decision, even though it's a recommendation. And most of my clients just will say yes because they trust me, and I appreciate that. But for due diligence purposes, I do need to make sure that you understand the risk. If you're a do-it-yourself investor, I want to make sure you understand. And if you don't know me, I want you to get to know me. I hope you'll get to spend a little time, get to know, like, and trust me. But to do that, I'm going to provide some very helpful training on how to set up your portfolio and how to manage it. I really have a lot of do-it-yourself investors in my community, especially on LinkedIn. And so I want to do that for you because one day, I believe, just like for myself, one day you're not going to want to manage your own investments, and you're going to want to hand that off to somebody you trust. And I'm hoping to be that person. And so thirdly, the reason I'm doing training around this bull bear risk management strategy is because it's not complicated. It's pretty simple, but the truth is it takes time. And I love my job, but I would much rather spend time with clients than to be looking at charts every day for a few hours a day. And to do this strategy and to do it right, it requires trained eyeballs to be looking at charts. And I'll show you what I mean in the weeks ahead. But for now, let me just tell you that a big part of this strategy, the BayRock Bear strategy, involves some investment vehicles that have a much higher level of risk. So I'm talking about leveraged ETFs and inverse ETFs. We will not be putting those strategies in place for very long. They're very short term, but they work very well. I've used them for years. They work very well to actually make money in a down market. So that's what this strategy is built on, but you don't have to agree to use those higher risk instruments in your portfolio. It works well without it. Also, the only thing is you'll never make money in a down market if you don't have a strategy like the BayRock Bear strategy. So there's lots of ways to short the market. This strategy is for tax qualified accounts, Roth IRAs, any kind of tax qualified account. We have a different strategy for taxable accounts. It's very similar, but it is different. It includes margin and it includes options. And so those are things that I'm going to be talking to you about if you're a client, to make some changes to your account so that I have the ability to trade options and to short stocks in your taxable account. So again, if you're a client, we'll be having a conversation and I'll be making some changes once you authorize that. If you're a do-it-yourself investor, again, follow along and I'll teach you how to do that for yourself. And if you're interested in working for BayRock, either as a financial planner or an investment management professional, portfolio manager, you want to pay attention to this training because before I interview you, I'm going to want to know that you know how we do this strategy. So that's why I started BayRock. Now listen, over the past few years, we've been in a massive bull market, except for 2020. Around March, we had a bear market. It lasted about 5 minutes. And then after that, the S&P 500, which is what I call the market. The S&P 500 is the most focused on index on the planet. So as you will see, as you probably already know, when I talk about the market, that's really what I'm thinking is the S&P 500. It's the 500 biggest stocks, biggest companies in the United States, and they do business around the world. So I like the S&P 500. And again, it's the most focused on index in the entire planet. So if you want to know what the market's going to do, if you can tell me what the S&P 500 is going to do, I can tell you what the market's going to do. When the S&P 500 goes up, 75% of all the stocks in the market go up with it. When the S&P 500 goes down, 95% of all the stocks in the market go down with the S&P 500. So In 2021 alone, we hit 68 new all-time highs. So that's a bull market. But the truth is, the stock market, the markets, unlike Houston, Texas, the markets have 4 seasons. One is an uptrend, a bull market. And that's important to know. And it's important to be able to distinguish between a bull market and a bear market when we have a downtrending market. And so those are two of the seasons in the stock market. And another one is consolidation. It's kind of when the market goes sideways and it's consolidating. Another one is uncertainty. And that is what we've been in the last month, the last 6 weeks or so, is uncertainty, which creates a tremendous amount of volatility. And that's why this strategy is coming into place, because that is the season we're in. And even though today is an amazing day in the market, let me just jump over to, I'm going to jump into Schwab, and I'm going to show you this is the portfolio that I built for the bulls. So you can see there's only 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 holdings, including one bond, the TLT. But let's hit the heat map. So today's a big day, a big up day in the market. It looks pretty good. And your account would be looking very good if you're in this BayRock Bull portfolio. So I'm going to go over these portfolios and show you how to distinguish them. But before I do that, let me just show you the BayRock Bear strategy so you can see kind of what we're building on. So this this heat map that you're looking at represents the holdings that are in the BayRock Bear portfolio. So it's looking very, very ugly today. And this is a very, very ugly portfolio. From every metric that I use to measure the instruments that we put into your portfolio, this portfolio that you're looking at now, the heat map, represents some holdings like the DOG, the dog. That goes up when the Dow goes down. Look at SDS. Somewhere on this list is SDS. And if you notice, it's down almost 6% today, because the SPY, which is the proxy for the S&P 500, is up almost 3%. So this bear strategy portfolio is not something we want to set and forget. This is something we do in a very surgical way, in a very short time frame. But again, it's a very powerful tool if you want to hope to make money in a down market. It's the easiest, simplest way that I know of for your tax-advantaged accounts, tax-qualified accounts, IRA, Roth IRA, to put this strategy into place. I can push a button and incept this portfolio, transition your portfolio from the bull, let's go back to the bull, because this is what we want to be in on a day like today, is this bull portfolio. So that's where you would be today. And actually, you wouldn't be there. You would be in this same portfolio, but I'm going to show you what's called BayRock half cash, because in a volatile market, even though we have days like today, awesome days like today, we have other days where it's just not, it's going way down, and you know that. So right now, my portfolios are in half cash. That's a lot of cash, but it gives me the ability, when the time is right, and I'll be talking about how you know when the time is right, what indicators we're going to look at to make sure that we go into the right portfolio design for you. But it's basically three different portfolios built into one strategy. BayRock Bull, half cash, which is where we go to half cash for those consolidating periods when we're in some volatile markets. So we get the opportunity to make gains on a day like today, but we lose half as much on days when it's down. So the other one is just the bear. And the bear, again, this is where the risk is, and this is where I'm recommending we do this, but this will be a very short period that this strategy or this portfolio is actually in place. Okay, so now I'm going to go back to the presentation. So kind of gave you an overview of the market. You saw those tickers. You saw what's built into this portfolio, the S&P 500, the Dow, the NASDAQ. Those are all what you just saw in those tickers. The small cap, the mid cap, the chip sector, semiconductor, ARC Innovation, which has gotten hammered lately, but it's something I think we need to be in a little bit. Biotech, and then the bond proxy, and then you didn't see the international. That's not in there yet, but it will be. Okay, so here's some things I'm looking at. Simple moving averages. So let me just jump in and show you what I've done is I've opened a watch list using the tool that I use for trading, and we're looking at a list of the same tickers, the same holdings that are built into the bull bear strategy. So I'm going to open up the SPY. Okay, so I opened up the SPY, that's the Standard & Poor's 500, and nothing represents the market better than the S&P 500. And if I could only invest in one investment ever, it would be the SPY. It's an exchange-traded fund, which is what all of these holdings are, an ETF, not a mutual fund. And this is the S&P 500, the SPY. So you can see today we got a really strong candle, meaning it's up a lot. But if you look at this is a 6-month chart. If you look at it, you'll see these 4 indicators. These are the indicators that we watch a lot, that I watch every day. And so what we have is that purple is the 8-day moving average. It's a simple moving average. And then the green dotted line, that is the 20-day moving average. And then that thicker purple line is the 50-day moving average. And above that, the thick red line is the 200-day moving average. The reason that's important is because when we get into a market like we're in now, you see how much that's dropped. The S&P 500, the SPY has dropped from $479 all the way down to $427. That's a huge drop. Now it's up almost 3% today. That's great, but when it starts to hit these support and resistance levels, and each of those moving averages are now resistance. It broke through the 8-day, now it's bumping up against the 20-day. It may break through that, and then it may hit the 50-day, and that will be the resistance. Now, if it breaks through that, we're shifting the trend from a downtrend to an uptrend, or at least we're on the verge. That's what we're looking for. But when we drop down, when that 50-day moving average drops below the 200-day moving average, that's called a death cross, and it's what it sounds like. It means things are bad in the market, and you see that happened a while back. And so once these ETFs start trading below the 200 and the 50-day moving average, it becomes very difficult for them to get back above that, and that's what causes a downtrending bear market. And that's why this strategy is important to understand. Inverse ETF for the S&P 500. So you see that one is trading above the 50-day and the 200-day moving average. So if I had to make a bet, if I was going to put some money in the market right now this minute, I would buy the SDS because it's probably going to, it's not probably, the probability would be more likely that this one would bounce off of those moving averages because the S&P 500, the SPY, is more likely to hit the resistance and bounce back. It may only happen for a minute. It may only happen for a day. You never know. But that's the idea here. So the strategies that we're looking at are designed to take advantage of and to carefully manage risk and opportunity. So again, it's all based on your risk number. You'll need to do the take your risk survey and figure out what your number is. If you're a client, I already know that. If you're a do-it-yourself investor, you're going to want to do that. So here's the crux of this strategy and all of our portfolio management. You see we have the BayRock 40, 50, 60, 70. We have a BayRock 80 somewhere, but these portfolios are designed to correspond with your risk number. So if you take the survey and you get a risk number of 52, then I would say let's go with the BayRock 50, and that would be your portfolio. The problem is, well, not the problem. What I do for my clients is I tell you when we get to certain heights in the market, I will move you from if you're a 50, I'll move you to a 40 just to protect those gains. And then when we start to see the market go back up like it is today, when we're confident it's going to go up, I'll put you in even more risky of a portfolio. Like if your number was 50, I might put you in a 60. So that's worked very well over the last couple of years, but I'm concerned that it may not work so well moving forward. And it certainly won't give us the ability to make money in a down market. And if we get into an extended down market, we'll look back and we'll say, hey, we probably should have done something different in order to make money in a down market, in a bear market. And even though today's a great day, I don't expect that it's going to be a new all-time high in the next 5 minutes or the next 5 weeks. But we'll see. We'll keep our eyes on it. So the BayRock, bear, bull, and half cash, those are the real key elements of this strategy. So if you just scroll down in this post, you'll be able to download a report, and you really need to look at the entire report. Find your risk number. If you're a 50, a 60, whatever, then go grab that report and take a peek at it. And what you're going to see is I've compared the portfolio that you normally would have with a lower risk portfolio, just so you can see why it's important to know how much risk you need. In other words, if you have goals and over time, having a higher exposure to the market is going to give you better returns. We all know that. So I showed just a basic comparison of each of these portfolios against something that's a lower risk. And that's what people usually do when they get afraid, is they go into lower risk, and that ends up costing them. So you can see the comparisons in each of these stress tests: bull market, a bear market, if we had another financial crisis, or if we had a 134 basis point rate hike. So each of those are there with the corresponding risk portfolio, whichever number you would have. So I'm just going to scroll down now and show you what the real point of this presentation is. And that is these new strategies, the BayRock Bull. And we've taken out all the fixed income and just made it basically the equities. And so it's a 73, that's the number. And then I'm comparing that with the half cash. What I've done with my accounts right now is I'm in half cash. So it's the BayRock Bull portfolio, but we've added half cash. So instead of being fully in the BayRock Bull right now, I'm missing out on half of today's returns. And you can see that if you go down and just look at a bull market. If you were in the BayRock Bull, over time, you'd have a $286,000 gain on $1 million account. And you'd have a loss, or not a loss, but you'd have a gain only of $119,000 if you were in the portfolio that I'm in today, which is the BayRock half cash. So if you look at the bear market, though, you see that I would have lost, or you would have lost, if you were in the BayRock Bull, you would have lost 33%. The S&P 500 would have lost 36%, but my half cash account would have only lost 12%. So that's a way better strategy than staying a bull in a bear market. So here's the bull versus the bear, BayRock Bull versus BayRock Bear, and you can see the comparisons there. And by the way, if you're ever stuck in the BayRock Bear portfolio during a bull market or anything like it, you absolutely should terminate your investment advisor immediately. If you're losing money in a bear market, which you absolutely would do if you were in the BayRock Bear portfolio during a bull market, you're going to lose money, and that's not what we're doing this for. So this just shows you the difference between the BayRock Bull and the BayRock Bear. Obviously, if we were in the bear portfolio during a crisis, we would make pretty decent money. That's the whole point. So then we got the BayRock half cash versus BayRock Bear. So let's say that you don't like the idea of having the extra risk of inverse ETFs and leveraged ETFs. You can say, I don't like that. That's too much risk. That's what my wife would say. And so if we did that portfolio, let's compare those. Half cash, which is what I'm in today, versus the BayRock Bear. Half cash would have done much better in a bull market, obviously, but only half as good as the S&P 500, obviously. If we go to a bear market, though, look at that. Half cash does half as bad as the S&P 500, but the BayRock Bear does quite nicely. And that's what I'm going to be doing in my portfolio because I'm not afraid of the risk, because I know what the opportunity looks like in a down market if you know what you're doing. And so again, there is more risk. You need to understand that. I'll help you figure that out. If you're interested, just click on the link to book a meeting with me, and I'll go over this. I'll show you when you do if you're a do-it-yourself investor, if you're not a client, do that survey, and I'll reach out to you and I'll get your portfolio and we'll do a comparison with your portfolio. If you're a client, we'll do the same thing. We'll have a conversation to find out if this strategy is right for you. So I hope that's been helpful. There'll be much more to come. So I'm just going to scroll to the top of the page at BayRockFinancial.com. And you'll notice, again, there are 4 buttons, blue buttons at the top of the page. Subscribe to the podcast so you can follow along as I do this training, whether you're a do-it-yourself investor or a client. I hope you'll do that. Subscribe, leave a 5-star review if you'd like. I'd be grateful. And you can enroll in our online course. That's where I'll be posting the training. And then get your risk number. If you haven't done that, or if you're not sure, if you need to update it, click on that blue button, get your risk number, and that's the way to get started. When you're ready to update your plan, just click on that blue button, and we'll go right into your financial plan. This is all free if you're a do-it-yourself investor. It's my way of earning your trust. If you're a client and you didn't know this was here, well, now you do. So let's talk. If you're a client, I need your permission. I'm not going to do anything until you give me authorization. I'll need a new agreement, an updated agreement to show that you've accepted the risk of the leveraged and inverse ETFs if you want to go with the bear strategy at any point. And also, I need a new agreement, and I'll send you. I always send new clients in when we make changes in your portfolio. You get a new investment policy statement, which will outline, and that's basically what you get if you download any of these reports. So again, please read those disclosures so that you know that this is for illustrative and educational purposes only. I'm making no recommendations to anyone right now, but I will tell you what my recommendations would be if I knew enough about your financial situation to know that it made sense, like it makes sense for me and my family. So thanks for watching my video. I'll see you soon. Look forward to talking to you. Have a great